Spotify reported earnings before the market opened on Tuesday, and results looked really positive. The market's reaction looks really good. Stocks up about 14% as I'm recording early in the day on Tuesday. So I want to dig through the results and where there was some positives, where there was actually some negatives as well. Well, a couple of things that stood out that was a little bit disappointing was the monthly active user growth. And management spent a lot of time on the conference call talking about exactly what's going on there. So we'll go through some of the detail there. And then advertising continues to be a little bit weak. That's where I think the ultimate massive upside is for Spotify if they can get the advertising business right. But they're definitely not there yet. Maybe steps in the right direction. But we definitely got a lot of progress on the premium business and monetizing that a little bit better. So I'm going to dig through all this today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get right to the results. This is a look at the executive summary. So this gives you an overall view of exactly what's going on in the quarter, kind of the big metrics that we're looking at as investors. So let's start here with monthly active users. So that's the top number, 626 million monthly active users. Just a phenomenal number of users. There's only a handful of companies that have that many users. They're on their way to 1 billion users, I think definitely by the end of the decade. But this quarter over quarter growth, just 2%. Just 11 million new monthly active users added in the quarter, but you can see that this is broken down into a little bit faster growth on the premium side, 246 million now on the premium side, up 3% quarter over quarter, and only 5 million added on the ad-supported side. This is what they spent a fair amount of time talking about on the conference call, that they're seeing that the ROI on a lot of these ad-supported users, which are in developing markets primarily, is just not very high. So they're not going to spend a lot of money or a lot of effort trying to attract users that aren't going to add much value to the business. And this is really the transition that we've seen Spotify go through over the past couple of years, is saying, hey, we need to focus on being a real business, a business that makes money. And that's where, if you go down to the bottom line, now 490 million euros, these numbers are in euros, generated in free cash flow in the most recent quarter. So I'll put a little bit more context in that in just a second, show a little chart that shows the trend there, but that's a phenomenal number. I have said that they could get to $1 billion in free cash flow on a per quarter basis by the end of this year. That seemed wild early in the year, late last year. Now it's coming a little bit more into focus. Most of the growth that you see here on the financial side, that's that second segment, is in the premium business, 3.35 billion euros, up 21% year over year and 3% quarter over quarter. The ad-supported business is continuing to grow 13%, but like I said, not keeping up with the growth in monthly active users. So there's a little bit of disappointment there. I think that's ultimately still where a lot of the upside is for the business, but we're not there yet with that ad-supported business maturing. But investors are obviously focused today on how well premium is doing. Gross profit, 1.1 billion euros, up 45% year over year and 11% quarter over quarter. So the monetization, the operating leverage, that's really what investors are excited about today. Here's performance compared to what they gave for guidance. So this is what I was talking about earlier. Monthly active users a little bit below guidance, although premium subscribers were above guidance. So there's the balance there. Great for financials that you're having more premium subscribers, but the long-term growth is going to be driven by the user number overall. So a little bit of good, a little bit of bad. Something that management is definitely going to have to balance over the next few years. Revenue growth was in line, but gross profit and operating income were above their guidance. And that is really the focus for investors, for Spotify's management, is that monetizing the business right now. This is the big trend over the past year, this gross margin trend, 24.1% up to 29.2%, on their way to being over 30% gross margin. So just phenomenal performance, and that's how you get to this operating leverage that you see below. Going to be a little bit of a stretch to double this number over the next couple of quarters, but I think maybe next year we will see $1 billion in free cash flow on a quarterly basis. This is the other one that I wanted to highlight. Total gross margin is obviously up. So this is a solid number, premium gross margin over 30%. That was something I think was a little bit of a stretch a few years ago, but after some of the recent price increases, that has helped push margins up on the premium side. The ad-supported business, you want this number to get up to more like 30-40%, but we're clearly not there yet. They're not at scale with the ad-supported business, and it just isn't that big of a business overall for them. So again, this is where the biggest opportunity is monetizing a bigger user base who are ad supported than premium. but right now, just not mature enough to be a huge piece of the business. Operating expenses continue to come down. Total operating expenses year over year, that's what this purple line is. You can see that down 16% year over year. This is the right trend that you want to see for a business like this. So revenue is going up, expenses are coming down. That is operating leverage. Free cash flow, again, this is the chart that I mentioned earlier. Look at this is a trailing 12-month number. So free cash flow has essentially gone from break even in Q2 2023 to now getting close to 1.5 billion euros in annualized free cash flow. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The other thing that management talked about that they didn't give specific numbers on was that churn was a little bit lower than expected in their second price increase of the past year. And this is something I've talked about on this channel, is that the real opportunity for Spotify is not just building out the music business the way that we know it as over the past 15 years or so. It's bundling more and more services. So they have music bundled with audiobooks. Then you have also potential value coming from podcasts and video. But if you're bundling that all together with one price, that can be a huge value for consumers, even if it's a higher price than a competing service for just music. And that's where we're at today with Spotify. The baseline subscription for premium for Spotify is a little bit more expensive than it is for Apple Music or for YouTube Music. So they're pushing on price. And what management said is that churn or cancellations when that most recent price increase went through were actually better than expected and lower than they were in the previous price increase. So it seems like there is at least a little bit of pricing power for Spotify, and that is ultimately going to be the most positive thing for the business, because if they're able to bundle all these things together a little bit the way that cable did, where you may value music, maybe I value podcasts, the next person values video, another person values audiobooks, everybody's getting value from the subscription, but they're able to increase the price of that bundle overall and actually generate a higher margin than just selling music, where the record labels ultimately have control of that music and are able to squeeze all the margin out that Spotify is able to generate. So that's really, I think, what's positive, was that churn on this recent price increase was lower than they had anticipated. That should lead to a little bit better margins. I think that's why you're seeing those premium gross margins be a little bit over 30%. If they can continue that and they can continue to grow this ad-supported business, this will be a phenomenally profitable business. I think we're really starting to see that really play out over the past year. But that's why this has been the biggest holding in the asymmetric investing portfolio, is because these trends we have seen coming for quite a while. The operating expenses were going to come down. They had a few layoffs last year. We've seen these price increases go through. Monthly active users continue to go up. So now we're just seeing fruit from all of those investments. So I think there's a lot to like about the quarter. The biggest thing that I would like to see in the future is improvement in the ad-supported business. But I will definitely take improvement in the premium business and that pricing power that we saw this quarter over ad-supported, which I think is a little bit more of a long-term play. But what do you think of the quarter and the market's reaction? Like I said, as I'm recording, stock's up about 14%. We'll see where things end on Tuesday. Let me know in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.